We're joined today by Andrew Lawrence from Barclays Capital, head of regional property research. The numbers out of China, of course, we're watching them closely. What do you make of the impact to the Hong Kong property market as well?
Yeah, certainly. I mean, I think what we're seeing, obviously, is a slowdown in the China property market, but that resembles particularly Chinese measures that have come through. In Hong Kong, the market's more dominated by the credit side and what's happening in the banking sector, particularly the tightening of liquidity in the Hong Kong market, and that feeding through into higher mortgage rates and higher rates for corporates as well.
Let's talk about your outlook for the Hong Kong property sector, because I'm very interested in whether you see a soft landing here or a hard landing. Your reports have forecast a 25 to 30% price decline for property prices here?
That's correct. I mean, this is largely predicated on the back of the tight liquidity. You know, we've moved from HIBOR plus 65 basis points on mortgages to today a 3% mortgage rate from the banks, and we expect we'll be up at 4.5 to 5% by the end of 2012. Now, feeding through, that obviously impacts affordability, the amount you can pay on the monthly mortgage, but it also has an impact on the amount that you can borrow from banks. And feeding through, that effectively means a 25 to 30% fall in order to bring prices back to levels where first-time buyers can move back into the market and afford to pay high prices.
So this perhaps restricted access to credit for these big developers in Hong Kong, what does it mean for investors? The share prices of these are obviously closely watched and very heavily invested by many people here in Hong Kong.
Yes, certainly. And we've been expecting since March a 25 to 30% fall in share prices to reflect our outlook for the next 18 months or so. And we're starting to see that move through in the stocks. We still see further downside to the big developers, certainly with the slowdown in the physical market and also the increased funding costs. Developers back in sort of 2007, 2008 were able to get syndicate loans at less than 50 basis points. Today, to refinance those syndicate loans, they're looking at somewhere in the region of 3.5 to 400 basis points. So you're going to see an 8-fold increase in their funding costs over the next 2 years as debt matures. So that's going to see a material impact to P&Ls.
Does that have an impact on projects? I mean, will we see these Hong Kong developers scaling back projects here or scaling back projects in mainland China, where in many cases they have big projects underway?
Yeah, it will do. I mean, what we're seeing from developers is the first step is to try and speed up your sales to bring in cash. And clearly we've seen developers try and push more primary projects out to the market, really since about October, November, when we started to see a rising syndicate loan cost. We're seeing also some commercial buildings come back to the market for sale as well. So developers are pushing out projects first. Secondly, we suspect it's going to start hitting the land market. So higher funding costs are going to mean lower land prices. And also the yields on properties are going to have to move out to reflect higher funding costs, and therefore we get lower commercial values across the market.
Do you see the government here taking any actions to ease its property curves? I know there's been a lot of speculation on this. Is that something that they are prepared to do?
I think as we move through into 2012, we probably will see the government take off its special stamp duty. I think because of the catch-all nature of the measure, as we go into perhaps a slowdown in the economic environment, there will be people who have to sell, who perhaps lost their job, can't afford to pay the mortgage, etc., and therefore the stamp duty would capture them as well. So I suspect the government will want to try and come out of the stamp duty measures early before we go in to see any particular pickup in unemployment. That said, if I look both at the stamp duty measures and the LTV measures, we've got to recognise that they're demand-side measures, but actually we're seeing demand falling off anyway because of the higher mortgage rates. So it's unlikely that they're going to have a material impact on the market even when they're taken off. In fact, the special stamp duty might mean that we see more supply coming to the market as investors who bought wanted to get out. Now they no longer have to pay the tax.
Interesting, interesting. One final question for you here. Sun Hung Kai Properties, Henderson Land, do you see them doing equity issues early next year? Are these two that you're in particular watching?
I think these are two that we're particularly watching. Firstly, because their debt levels are, in absolute terms, Sun Hung Kai has the largest amount of debt that it's ever had on its balance sheet. Yeah? Clearly what we're seeing is them selling projects quickly. And both have gone to the bond market to raise money at 3.5 to 4%. So while we're not saying that these will definitely come to the market, we're saying that there are certain developers who perhaps are more likely to come than others. And Sun Hung Kai and Henderson would be two of those.
What to watch as we go into the new year. Andrew Lawrence, thank you for your time. Andrew Lawrence, head of regional property from Barclays Capital, joining us live today. Thank you for your time.